Good everyone, welcome back to our next edition of Econ Talks. Gareth, we've seen further conflict arise in the Middle East after earlier strikes between Israel and Iran across the board over the last week or so had seen oil prices up between sort of 7 and 10%, depending on which one and what time frame you were looking at. What was already an unstable part of the world got even more so with an escalation in tensions over the weekend, with the US commencing Operation Midnight Hammer to strike Iran's nuclear plants. That was the escalation that we were sort of all worried about. Up until then, it had been just a two-state conflict going between Israel and Iran, and although it certainly was clearly devastating, it hadn't widened out into a broader regional picture. It hadn't seen quite the same response, I guess, as other areas. Now that you've got this broader response, the US has now entered the conflict directly, if you will. You've now got concerns about the sort of wider escalation that could bring for the region, and in particular, what the immediate retaliation might be from the Iranians. Of course, they've just been struck, and normally this will see an increase in the likes of oil prices. People are worried about what that means. They'll be thinking about what it means for the likes of economic activity. We have seen a number of conflicts, Gareth, in the Middle East before. It does feel like it is something a bit new. We have seen quite a escalation in tensions quite quickly. You're hearing some fairly veteran foreign affairs officials now suggesting this is the sort of worst international tensions that they've seen since the likes of the Cuban Missile Crisis. Perhaps we're underplaying it here, but it doesn't seem to be coming through in the numbers quite as quickly. Is that just a sort of uncertainty? And going forward, what do you expect an event like this will do to both international markets and to everything else in the domestic economy here at home?
Yeah, it's an interesting one in terms of oil prices. When you look at previous conflicts in the Middle East over the last 30, 40, 50 years, often there's quite a quick response in oil prices, and a large one. It can be a rise of maybe 50 or 100% in terms of those international oil prices. So big in terms of the effect that it has on the price that Kiwis end up paying at the pump, particularly if you factor in possibly a bit of weakness in the exchange rate as well. What is interesting in terms of previous conflicts, whether you take the Iraq situation in 2003 or back in 1990 as well with the invasion of Kuwait, typically those oil price spikes didn't last that long in the grand scheme of things. They were sort of 3 to 6 months, which feels like a long time at that moment. But when you consider some of the concerns that are around at those stages, it's not really that long. So it can pass quite quickly. But who's to say whether this is a similar conflict? As you said, it looks like it's the sort of worst thing we've seen on the international stage in possibly a good 60 to 70 years. And so it may well, those prices may well behave differently to what we have seen in some of those previous, possibly more confined conflicts than what we're maybe facing now. In terms of the impact on economic activity, globally, there are fears of a recession if you've got higher oil prices coming through, negatively impacting on profitability and business activity. Of course, the economy is not the main thing you'd be worrying about if we're going into World War III, but that's some of the economic impacts that you'd expect internationally. And of course, from a New Zealand perspective, that negatively impacts our export markets. And we're also facing those higher costs as businesses, as households, in terms of fuel, in terms of transporting stuff as well. So whichever way you cut the numbers and look at it, it does look to be a negative for growth going forward. One point I would make on the oil prices at the moment, I mean, they're sort of sitting in the high $70 a barrel US, I think. Look, we were back at this level maybe 6 months ago, and we have seen with the tariffs internationally and the international uncertainty arising from that potential trade war, those oil prices had dropped substantially down into the mid to low $60 a barrel. So we're not at sort of really squeezing levels yet, but I think the risks are on the upside in terms of where those oil prices go to from here, given the potential for sort of retaliation from Iran, from a trade perspective to what's been going on, as well as just the sort of conflict spreading a bit more across the Middle East, which of course is a key supplier of oil for the globe overall. So plenty of downside risks there, I think, in terms of the outlook for growth, and upside risks, you have to say, in terms of costs for households and businesses going forward.
That's the interesting thing, right? I mean, looking through this, I mean, the potential for further escalation and that retaliation from Iran, that's really the wild card here. No one's quite sure how they will respond. Will they try and come back to the negotiating table, realizing that they are in a pretty difficult position, that the US is now actively willing to engage, and if so, they're willing to do it again? Seems to be the pretty strong view from the US president and from others within the wider US circle. At the same time, do they go, well, look, we're being quite clearly threatened, and therefore we're going to fight fire with fire? In that case, you could well see the likes of the Strait of Hormuz, which has about 20% of the world's oil production, go through it. You've already seen the Iranian parliament that has passed a resolution to allow for the strait to be closed. If that were to happen, you'd have to see the Supreme National Security Council of Iran that would make that declaration, and then you'd probably see the likes of Iranian naval assets start to mine parts of the strait. You've also, of course, got the US Fifth Fleet in region, quite a strong military force, but again, you could start to see a lot of conflict through in that area in terms of ship-to-ship conflict. You could have oil tankers, US military assets, and similar being attacked. You could see the likes of cyber attacks and similar as well. There's quite a variety of options potentially on the cards, but further escalation, of course, will, I think, ratchet up those tensions and those expectations that prices will go higher. Now, I guess, Gareth, looking at all of this, normally when oil prices go up, the Reserve Bank in New Zealand, at least, has taken a bit of a view that it tries to look through some of those short-term implications, and these could well be short-term. If you saw even a blockade of the Strait of Hormuz, if there was a feeling that, look, things will have to go diplomatic at some point, then eventually oil prices will calm down, people will figure out different supply chains. Normally they'd look through that. Are we in a different place now, however, given that you've got a little bit more inflationary pressure already there in front of us? Does that change the game?
Yeah, I feel like a bit of a broken record because we've talked about inflationary pressures through the course of this year, just starting to look more concerning, more critical than they had been previously. Forecast inflation pushed, I mean, it is at 2.5, potentially pushing up towards 3% in the second half of this year. And in that environment, plus the fact, of course, the Reserve Bank let inflation get out of control 3 years ago through the COVID pandemic, getting up to over 7% per annum, there is that sort of question of credibility the Reserve Bank will still be thinking about as well when you consider, what the sort of domestic price implications and cost implications may be. So, yeah, maybe the Reserve Bank normally would say we need to support the economy a little bit here because of some of the pressures from higher oil prices sucking money out from households and meaning that across the rest of the economy there'll be less spending occurring. But they will be concerned that there is sort of those underlying inflationary pressures, particularly domestically, just still hanging around and, potentially accelerating a little bit later this year as well. So I think for the moment for them, it does sort of come back to the previous statement where they were starting to communicate there weren't too many more cuts in there and they were kind of going to just see how things unfolded. Now, this is before, of course, the conflict has really kicked off in the Middle East. It was more related to what's been going on with the trade war and tariffs internationally. But nevertheless, I think the response is still the same, where they just may hold off in terms of cuts and say, well, actually, if anything, we may need to raise. So it's trying to find that balance, trying to find that tone that keeps markets under control on a line which they would like which the bank would like them to be progressing down, rather than getting too excited about, oh, there might be further cuts because things are, growth prospects, if anything, are not looking as good as they were. So, yeah, difficult position, and it will be a case of watching the news, watching the data day by day, and trying to assess what the most appropriate response is, particularly, as I say, given that credibility issue that the Reserve Bank will want to maintain.
And that, I guess, is my worry, right? You've already seen the likes of household, business, and professional forecaster inflation expectations just edge up a little bit. Not hugely, but just a little bit. And given the fact that I think you've already seen a lot of people saying, look, we need to sort of have more stimulus because, geez, looking forward, economic activity is not that good. Well, economic activity recently hasn't been that great either. And you know what? We've still had a bit more pricing pressure come through. That's sort of how we got ourselves into the likes of those higher inflationary times a couple of years back. We kept saying, look, there's going to be worse times ahead, and sort of almost conveniently ignored the fact that pricing pressures at that time, right here, right now, were increasing. And we're starting to see that again. I mean, any other time in economic history for New Zealand, you see an inflation rate of 2.5% and starting to push a bit higher, Reserve Bank wouldn't even be contemplating cuts. They'll be asking how many raises they need to put in. Now, I don't think we're there yet, but I do think we're getting closer than a lot of people expect, and that's the area to keep a focus on, because although yes, there look like there's weaker economic tones coming through, the sort of continual and multifaceted supply shock, because it's happening in a couple of areas at different points, that's probably the area of greatest risk going forward. We'll continue to assess that, what happens more broadly in the Middle East, what any retaliation and escalation might look like, and what it means for the New Zealand economy on one of our future editions of Econ Talks.